For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, welcome back to the podcast. Happy to be here, as I always am, and equally happy to have along, of course, my usual guy here, Professor Rick Plum, Certified Financial Planner Professional, Accredited Wealth Management Advisor. Rick, I tell you what, I just figured out, as we're recording this, we're already a quarter of the way through 2025. Now, by the time people
it's going fast,
isn't it? And by the time people are listening to this, it's going to be a little bit more than that. But honestly, I'm really losing track of time. And time is something that is on my mind a lot, especially as I get older. Not just time, but you know what I started thinking about was timing. Now,
something I've never been good at.
I didn't think I had either, but I was just thinking before we came on for this podcast, and this is kind of where I want to go today on this topic. Timing. I've had instances of really good timing and instances of really, really remarkably bad timing. And I'm sure I'm not the only one. You have. I mean, every once in a while, Professor, you've had some good timing. Haven't you, at some point?
I have had experienced some wonderful timing, but I wasn't smart enough to take advantage of it because I had an investment that I rode way up really fast. I got in at the right time. Man, I was doing great. And I needed it to go to a certain number in my mind. Mm-hmm. And when it hit a certain number, I had my order to sell.
Yeah.
It came within $1 of that dang number.
No.
The number was 150, by the way. And it got to 149 in 10 cents or something like that.
Yeah.
And never went anywhere close to 150 again. And within 2 months, it was down in the 40 range. And it was like,
yeah.
Now, I did sell out before I got to 40, but not that much before I got there, darn it.
Hey, yeah.
So I had really good timing on one side. And that's a problem with timing the market. You have to be right twice. You have to be right when you get in, and then you have to be right when to get out.
Exactly.
Because sometimes things don't work as you planned.
Well, they don't. And you just have to expect a certain amount of good luck and a certain amount of bad luck. And I think generally it evens out. It tends to even out for the most part. So my instances of bad timing are we've talked about on this program. But it got me to thinking about retiring at the quote unquote right time. And what happens if you retire at the wrong time? And by the wrong time, I'm really meaning that you built your portfolio up to a certain level, you hit that number, whatever it is, and your balance is where it needs to be. And you say, okay, I got enough money to retire now. I'm done. I'm quitting. I'm going to retire. And the market takes a big dive. We saw that in last time in 2022, almost like the 1st of January, close to that. So people who retired at the end of 21, having had a couple of really
good
years.
End of 2000 or end of 1999, it went down for 3 years straight.
Yeah. You're talking about after, from 2000. Yeah. But
2000, 2001, and 2002 were all negative years, which is unusual. It's very, very rare that we have 2, let alone 3 back-to-back negative years.
Well, but
it happens.
It does. Now, you throw 9/11 into that mix, it probably extended it a little bit. I don't know. But yes, you had that. You had some bubbles occurring. But for people who say retired more recently in 2022, early 2022, they had a problem if they were not properly, if they had not planned properly or had the proper withdrawal method. Now, all this again is to say that retiring at the wrong time, Professor Plum, has something to do with a kind of wonky thing that a lot of finance people know, but people who are not inside the world of finance don't know. And it's called sequence of returns risk. In other words, are you retiring at a good time in the markets, or are you going to retire at a bad time in the markets? Can you explain briefly what we mean by sequence of returns risk before we get into why it could really devastate you?
Well, there's been a lot of studies, and we've seen a lot of it just from watching and living through it, that the returns that you receive in the first 5 to 10 years of your retirement, when you start distributing money from your portfolio, those have a dramatic effect on the viability, the long-term viability of your overall portfolio. If the first 10 years are basically all positive, they don't even have to be big positive every year, just positive, then you're probably going to do fine regardless of what strategy you use. But on the other hand, if you have a couple of negative years in those first 5 to 10 years, they don't even have to be big negative years. They don't have to be a 2000 to 2001 downturn. They don't have to be a 2007, 2008 downturn, which 2008 was a very big downturn. They just have to be a couple of bad years in a row when you're pulling money out of a down market. That can devastate your overall portfolio. But when you talk about retiring at the wrong time, there is no such thing as retiring at the wrong time if you have enough money to do it at the beginning, because it's a matter of, if you do your plan the right way, you can strategize against retiring at the wrong time, is like you said.
Yeah.
So there are ways to get around the sequence of return, but the first thing you have to do is understand that there is such a thing as sequence of returns, and you need to protect against it.
Yeah, and that risk, of course, you don't know. You don't know when you retire.
Oh, you have no idea.
No, nobody knows. I mean, you can take logical guesses, but even logical guesses aren't going to help you, especially if you say, I need to retire now. I mean, maybe you don't have a choice.
Forget the need to retire now. I want to retire now. If that's where you're at, I want to retire at a specific time. When I hit a specific age, or when I hit a certain level of something, you need to be the one that dictates when you want to retire, not the market. The market is not an indicator of when you should or should not retire. Your ability to retire should be based on what you're doing and your goals and your plan. And this goes back to your planning. That's assuming you're doing some planning.
Well, yeah, and it may not even be your choice. I mean, it could be.
Unfortunately, that does happen. Illness, injury, things of that nature.
Layoffs
come into play. But the market is not a reason that you should be afraid to retire or not retire.
So can we go over just a little bit here what happens? This all comes down to the method that you use to take money out of your portfolio if and when you need it. And this is why we're such strong advocates of having safe money on the side to draw from for your short-term income needs, why we talk about matching your assets to your liabilities. We have a kind of a good illustration, Professor Plum, how this sequence of returns risk can hurt you. And let's talk about that again before we get into what the remedy may be.
Well, if you've ever downloaded our Bucket Strategy Retirement Guide, we have a couple of slides or a couple of illustrations in there that talk about all returns are not created equal. And it's a matter of looking at returns, but not in the way a lot of people do. Most people look at returns and what has my average return been over the past 5-10 years, whatever the number is that you're looking at. Average isn't going to be the way, unless you are a buy and hold for that period of time. Average doesn't do you any good, because that's not the return you're going to receive. And so what we did was we created a fictitious set of returns, and they showed positive returns. It's only a 15-year time horizon in our example. It showed positive returns over the first 10 years with negative returns over the last 5. And then we did the exact opposite, exact same returns, but in opposite order. So it had negative returns in the first 5-6 years, and then all the positive returns in the last several years. If you were a buy and hold investor for that period of time, you ended up with the same amount. Mm-hmm. Regardless of what, taking the emotion out of it that you sold when the market was going down, or you added to it when the market was going up just before it started going down. Take the emotion out of it. The average return was there.
If you just left it alone, you're saying?
If you just put in a chunk of money day one, left it alone for the 15-year time horizon in the example, mm-hmm. your ending result was not affected by early positive, late negative, early negative, late positive. As long as the returns were the same and the average came out the same, you had the same. In our example, we did a 4% average return over the 15 years. Now, not, let's see, yeah, 1 year was a minus 4%, but there was no other 4% in any given year. There were returns as high as 18% in our example and as low as minus 15 1 year in our example. But it ended up being a 4% return, buy and hold over that period of time. But a funny thing happened on the way to the bank. Most people don't have a lump sum to invest day one and leave it alone for 15 years. Most of us, you build our net worth by adding to it over time. You know, whether it's systematically through dollar cost averaging with our 401ks or doing an IRA or ever periodically adding. So what we did was say, okay, instead of looking at this as if we had a lump sum, let's look at it as if we had a dollar cost averaging sequence to it where we were adding money to it. Actually, we don't have that. We only have the negative one. We said, let's take money out of it. The reality was that if we were taking money out of, and this is going to highlight the sequence of returns aspect. In the example where we had positive returns in the first several years, plus 8, plus 11, plus 18, plus 14, plus 12, pretty good years, right? And then 9, 11, 9, 7, 5, and then 4, minus 4, minus 8, minus 15, minus 6, minus 7, 5. So return, and the ones at the end weren't that bad. You would think that you'd be okay. And the reality was, you start with X amount of dollars, you take a 5% withdrawal with no inflation adjustment. Your average return, because you had positive returns in the first part, even though you were taking money out of it, ended up being a 5% average return. So you actually helped because you had early positive sequence.
So in other words, if I may, just to clarify here, we're talking about a hypothetical 15-year period of time where we just made up numbers to illustrate the point. We had, 10 years of good...
They gave us a 4% long-term average return with no input or output of the money.
Over 15 years. But what we said
15 years.
But what we said was, well, let's make the first, say, 10 years decent or positive returns, right?
Yep.
And then the last 5 were negative to whatever degree.
Right.
Right.
But the average came out to be a 4% overall average over the 15-year time period.
So if you had that sequence where you had good 10 years and then 5 bad years immediately following that, and you were taking a 5% just flat withdrawal, no inflation adjustment every year during that 10-year good, 5-year bad, 15-year total.
5% of the original balance.
Yeah,
Yes.
5% of the original balance. You said that after 15 years, you wound up positive...
Well, you end up positive, but you also, instead of the investment itself had a 4% average rate of return from point A to point B. But when you were taking money out of it with the early positive returns, you increased your average rate of return from 4% to a little over 5%. So that positive sequence of returns in the beginning helped you out some.
Even though you were taking money out of it, you were still doing okay. And it's because that sequence, the initial sequence, the first 10 years or so in this hypothetical example was good. Now, we turn it around.
Right. And we use like I said, we use the exact same returns, just in the opposite order. And where a buy and hold was a 5%. The negative sequence of returns in the early years, and this again takes away the emotion of it, ended up being a minus 1% rate of return.
In other words,
on average over that 15-year period of time.
Okay, so now we're saying you start this sequence, this 15-year sequence, with the 5 bad years that were at the end of the other one. We take the 5 bad years first, and then we have 10 years of positive returns, uninterrupted positive returns. But the amount of money, and you're still taking the 5% of your original balance out every single year, even if it's down, you're taking that out. So it's a fixed amount of money. The dollar amount is the same. After those 15 years, the person whose sequence was bad for the first 5 years, but positive for the next 10, was not nearly as well off as if it had been in the reverse orders. That's correct.
Right. You're down. You're at risk of running out of money. I mean, if you live, it depends on how old you are at the time. If you're 95, you're probably not at risk. But if you started early, maybe you retired at 60 and now you're 75, you got a number of years left. There's risk to what you're going to do. And what it does is it puts emotional stress on you that I have to cut back on my spending. Now I'm no longer in control of what I want to do. The market told me what I can and can't do, and it told me I can't do what I want to do. I don't ever want to be in a position where the market tells me what I can and can't do. Yeah. I have enough other factors that tell me what I can and can't do. The market shouldn't be one of them.
And this is where the timing aspect of it comes into, because if you say I want to retire at this particular year, you could wind up with 2, 3, 4 bad years immediately.
And if you look at the returns, even though we have positive years, in the market and things of that nature, if we're taking a monthly distribution, it doesn't mean that every single month is positive. I may be experiencing down months while I'm taking money out. And if I'm selling things when they're down, that money can never recover. Mm-hmm. I can never achieve that average, that mm-hmm. better rate of return that the year actually gave me, because I wasn't in it for the year with at least that amount of money. So, in almost every single year, in even the decent sized positive years, at some point during that year, we were down. And if you were withdrawing money because you wanted to live, you're withdrawing it when it's down from where it started at the beginning of the year. Now, is that going to affect you? It can affect you. It depends on where we're at. And this is where we get back to strategy can override a lot of this problem. Mm-hmm. We've talked about in the past, there was a study done by Jen Hancock years ago about somebody who retired in 1969, and they had $100,000 and they wanted to take $5,000 a year out, 5%, similar to what we just talked about. But they used the actual return for a balanced portfolio, 50-50 mix of S&P 500 and a Barclays bond aggregate. And they said, okay, we're going to rebalance it every year because that's a very common way to do it. That's where probably more than half of the people manage their portfolio. They manage a balanced portfolio, and they just take systematic withdrawals from it. And then so somebody who started that in 1969 and somebody who started that in 1979. In 1969, that person made it 20 years, and they were completely out of money. That's not a good way to retire. I don't like that. Now, on the other hand, the person that retired and did the exact same strategy starting in 1979, they had tons of money left over because the 80s were good, and for the most part, the 90s were good. So they had lots of money left over.
But the late 60s, 69,
the 70s.
Yeah, for the first 5 years, there were a couple of down years. And it didn't have to be 5 straight years.
And there weren't any back-to-back years. They were just, and there weren't even big years for that. I don't remember off the top of my head, but I can't remember if there was even a double-digit down year. But there was like 3 or 4 flat to negative years in the first 10. But they were pulling that 5% mm-hmm. out each year. So it matters. And the problem is, when you're sitting in 1969 looking forward to retirement, you have no idea what the returns are going to be in the next 10. Same thing with 79, 80. Today, can you honestly tell me that somebody can tell me that the next 5 years, 10 years in the stock market, in the bond market, are going to be really good investment years so that I never have to worry about taking money out of the portfolio when it's down? There is always something that makes it go down from time to time. Sometimes it comes back fairly quickly. 2020 was a great example of that, but people freaked out. So the numbers also, we can look at the numbers and say, in 2020, it was actually a positive year in the market, but there was a part of that year where it wasn't quite so positive.
Well, and if you were taking money out during that trough, if you want to call it that, of 2020, you could wind up in trouble. So this is why we say that timing is important, but you can't always.
But you can't time it. Because timing says that I know what the future holds.
Well, but you can't. And you want to retire at a certain time, but you do not know what the next 2, 3, 4, 5 years is going to be. Is it going to be positive? Is it going to be negative? There's just no way to tell. So since there's no way to tell and there's no way to predict it, Professor Plum, it's much better, do you think, to have a strategy that will anticipate what could potentially happen without knowing what's going to happen and using that.
I'm going to say we're not even trying to anticipate. We don't know what's going to happen in the next 5, 6, 7, 8, 10 years. So we don't want to play the game. Let's just not even deal with the volatility. Let's forget about the volatility. Let's not play that game.
But how do you do that? I've got all this money sitting, and I have to live off of something, Professor Plum. He said in his most leading
You don't
voice.
have to have that money in the market that's playing the game.
Oh, okay.
You don't have to have all your money invested. And it's an issue because people say, well, I'll miss out on returns. Well, the returns, especially compounding, is a very, very, very powerful force of nature. Compounding returns. But the one thing that compounding returns needs is time. Mm-hmm. The difference over a year or two is not that great. The difference over 20 or 30 years can be really large. So what we want to do is we don't want to play the volatility game with money I need to spend in the next 1, 2, 3, 4, 5, 6, 7 years. I want to not have to worry about it. I don't want to think about it. Let's put money in this. Now that we've got some returns in T-bills and CDs and bank accounts and other things, well, bank accounts don't that good. We can put money, and we put enough money to withdraw principal and interest. I know that's kind of scary, but only from this portion of the portfolio, so that the rest of the portfolio, if it goes down tomorrow, so what? I don't have to sell it to make my bills. I've got years for it to recover. And that's why we set up buckets. Bucket number one is an investment that is not focused solely on return. In fact, return is not the primary focus at all. The ability to take a dollar from a dollar is the primary, concern there. We want to get as much return as we can. It's not like we're just sticking the money in the mattress, but so we're going to use high yield savings accounts. We're going to use treasuries. We're going to use CDs. We're going to use fixed guaranteed accounts that we know exactly what we're going to get and are not affected by downturns in the market and have appropriate liquidity. So if I need $50,000 a year, I have that $50,000 plus interest available to me when I need it this year, next year, the following year, so that I don't have to worry about, gosh, did the market crash? Oh no, I really don't want to take the money out right now because it's the bottom of 2022, or it's 2022, and the markets are pretty low, and the markets are off 25%. I really don't want to sell, so I'm not going to go do any of the things in retirement that I wanted to do, and I'm going to try to not even pay my mortgage or my bills, but they'll probably come after me. I'm just going to sit here and wait for the market to come back before I spend a dime. Well, that's no way to retire. Plus, your bill holders aren't going to let you do it anyway.
Right.
So keeping the money, bucket number one. Now, if the market goes up 40% next year, fine. Take the money that you want to spend and refill bucket number one. Reset your time horizon. What we call value averaging in this area. So it's a matter of just look for the opportunities, but don't play the game for the negative. I don't want to be in a game it's a 50% chance of losing money sometimes. It's just like, I don't like losing money. I'm sorry. No. It doesn't matter. I hate losing money. Let's set the strategy so you don't have to play that volatility game.
And what we're talking about, obviously, you just said is a bucket strategy that what we call it the bucket strategy that we've explained, of course, many times. And I think many of our listeners who are regular, who have been with us for all these many years and decades, probably understand. But it's always a good idea to remind people, I think, of why we think it's such a powerful way to go. Now, if you had $1 million, just to make it easy math, and you retired with that, and you put half of it in treasuries or bonds, and you put half of it in stocks, and you just took a systematic withdrawal every single year, you are running the risk, Professor Plum, as you illustrated, that if there's a bad sequence for the first 3, 4, 5 years of your retirement, as you're pulling money out and selling stocks to live off of, that portfolio value is going to go down considerably and may never recover. So
it doesn't even have to be 3 or 4 negative returns in the first 10. It could be 1. Mm-hmm. If you have a year like 2008. Remember the euphoria of investing in 2003, 4, 5, 6, 7? Mm-hmm. People were ecstatic about investing. They were all in. And then 2008 happened. And we were down at one point during the year almost 50% just in the S&P. And bonds were down too. So, everything was just taking it on the chin. And in early 2009, it was the same thing. And what happened was people that thought they could hold on through the downturn and people that didn't even need to spend the money sold out because they just got afraid. The emotional side took over. And it just, so there's two sides of this. It's the statistical, mathematical side and the emotional side, they both work to hurt you. Let's just say it that way. It just hurts. So whether it's a couple of years of marginal downturns, flat to down years, or one big year like a 2008, can you honestly tell me that we're not facing that going forward? I don't think we are, but hey, I don't know.
Well, I didn't think we were in 2006 and 7. I didn't see any of that coming. Now,
no, but we had a big one in 2008.
No. So yes, Professor Plum, by taking some money and not putting it into equities, which are historically, I think, over long time periods, probably do better than the safer assets, I would say.
Oh, very much so.
Certainly.
You take almost any 20-year period of time, and it outperforms the safe assets. A 15-year period of time, it outperforms safe assets. But that's if you're a buy and hold.
Yes. So, but if you're taking the money out, yes, you're taking some money off the top, and you're not going to get as good a return as you would have if you just left it in and let it fly, if indeed it did go up. But that's not the point. The point is that you don't want to have to worry about it.
Well, going back to how much is it going to cost me? I mean, I haven't done it for every single potential area, but that John Hancock study where they took the 1969 retiree, the end of 1969, so basically beginning of 70, and the beginning of 1980 retiree. I did they gave me the rates of return that were earned on the portfolio annually. And so I went in and said, let's do a very simplistic buckets plan on this. And what would it do? And so I took the first person who, in their example, they had $100,000. They took $5,000 a year out. I said, okay, let's take $50,000 of the money and put it in a cookie jar, earning absolutely nothing. I don't even want to earn what T-bills or treasuries could have earned back then. And then with $50,000 in the cookie jar, I could take $5,000 a year out for 10 years, right? But that leaves the portfolio alone. The other $50,000 was put in the portfolio, and we just left it alone for those 10 years. And then at the end of 10 years, I pulled $50,000 out of the portfolio if there was there and put it in the cookie jar and gave myself another 10 years worth of distributions. Very simplistic, over-the-top simplistic buckets plan. At the end of the 20 years, where if you had been invested the whole time, you were out of money at the 20 years. At the end of 20 years, that person still had $102,000 left.
The one with the cookie jar.
The one with the cookie jar had $102,000 left. Same exact returns, just using, and in fact, that would be considered more conservative by having money in the cookie jar than having it all in the market or in that particular 50-50 investment. And so so it worked with that negative sequence of returns in the early years. What did I have to give up? What was the cost to me if I did that at the beginning of a good period of time with not knowing it was going to be a good period of time? So we took a look at that person that retired in 1916 or 79, beginning of 1980, doing exactly the same thing. And we looked at it 30 years later. Over 30 years, the investment portfolio, if it had just been left alone the way they did it, had about $600,000. It started with 100, took $5,000 a year out of the portfolio. For 30 years, they had $600,000 left over. If they had cookie jarred it, my basic illustration here, they would have only had a little over $500,000. Yes, it did cost them. They gave up about $100,000 on that sequence of return. What's that, 18% from 600 down to 500? They gave about 18% of their overall portfolio. But in the negative sequence of returns, they had $100,000 left over instead of being broke. Now, I don't know, I haven't asked everybody, but if you were saying, would you rather have 500,000 instead of 600,000 30 years now, instead of going broke 20 years from now, depending upon what's going on, which way would you rather go? Most people would say, I'd rather not go broke. 500,000 sounds pretty good compared to, 600,000 sounds better, but broke doesn't sound very good at all.
Yeah.
Now, we don't know what's happening in the next 5 to 10 years. And that's why we can't actually make that decision like that, because we can't make those offers because we have no idea. So instead of worrying about it and wondering, okay, is this a good sequence or a bad sequence? Let's take that out of the game. Let's take that sequence out of the whole thing and say, you know what? I'm not playing the game. I'm going to do it my way. I want to retire when I want to retire. I want to retire with the income I want to retire with, and I do not want to worry about the market.
It's why we strategize and why we talk about things like the bucket strategy. Professor Plum, you mentioned there's a guide. I think the guide really illustrates it, and I don't mention this often enough. I should mention it, and I will now, that if you go to luciacap.com, LUCIACAP.com, and up in the upper right corner, you'll see a search bar there. Type in bucket strategy. The first thing that pops up should be the guide in that list of things that'll pop up. You could download it. I forget how long it is, but if you just want to get the gist, understand how it works, I think there are probably 3 pages, with illustrations and all that stuff. There's not a lot of reading to do on that before you can understand it. And that guide will give you all the details, too. I mean, I'd encourage you to read it all the way just to get the details. But just to at least understand this, you can do that. Go to luciacap.com and type in bucket strategy there. And you can download it. Of course, it's free. To anybody, and read it and get an idea kind of what we're sort of trying to talk about here in it's an abstract way to do it on a podcast without any illustrations. So I'm hoping people are able to follow this, but the idea to have that sort of money off to the side, because the question of what happens if you retire at the quote unquote wrong time, if you have a strategy that may help deal with that, there really is no wrong time, in my opinion, Professor Plum, to retire. And I would like that. I don't want to have to worry about whether or not the markets are going to be bad over the next, couple of years, 3, 4, 5 years when I retire. I just want to enjoy retirement. That's all I want to do.
If you're wondering if now a good time to retire or a bad time, and your deciding factor is now a good time to retire because of the market, you're not doing it right.
Well, yes, and we don't know. I mean, who knows what this year is going to bring? You're
asking a question that cannot be answered until after the fact.
We found that we don't even know what the next week is going to bring. It's been that bad. But you don't want to have to worry about that, and this is why we do that. As I said, luciacap.com, you can learn more about this. It's our way of talking about the bucket strategy, but I would encourage you to go to there and at least download the guide and read it. And if you have any questions on it, you can talk to Professor Plum or any of the Lucia Capital Group advisors, 800-644-1150, their phone number at Lucia Capital Group, 800-644-1150. There are some other guides on there, too, if you already know about the bucket strategy, but you want to know more about Social Security. There's a Social Security decision kit. Type that into the search bar. We've got an estate planning guide. We have a few others. I should write these down, but I'm not organized. You'll see it right there at luciacap.com. And again, you can give them a call at 800-644-1150 and talk to any of the Lucia Capital Group advisors who can help you out through these things. Professor, I believe that everybody there really knows buckets.
Yep.
Yeah,
it's drilled into us.
Well, it really is, and we're always learning, and we're always tweaking it, and it's just something that we're born to do. Let's see. Oh, this podcast. Well, you should subscribe first of all, as I try to remind everybody, because that way you can listen to it. Go to Apple Podcasts and Spotify. Make sure you subscribe so that you hear every single episode and don't miss anything. And again, if there is something you'd like us to address, you can certainly do that. You can email us there at luciacap.com and tell us what you'd like us to talk about. We try to make sure that whatever we talk about is relevant to every one of you in some form or another. And I think these the markets and retiring at the right or wrong time, I think that is relevant to just about everybody at some point in their lives. Professor Plum, I appreciate this. And again, if you check that guide, this will give you a little bit better representation of what it is we're talking about here. I know you've got some stuff to do. Again, Professor Plum, I always grab you right before you got to go. So,
well, I'm trying to squeeze these in.
Well, that's exactly what we do. So I thank you very much, Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. Love saying that because it's drilled into my head like everything else. For this guy, I'm your podcast host, Johnny Dean. Thanks so much for listening. Thanks for joining us, managing your financial future. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. A dollar cost averaging and value averaging strategies do not guarantee a profit or protection from loss. You must consider your willingness to continue purchasing during periods of high or low price levels. S&P 500 Index is an unmanaged index that includes a representative sample of large cap U.S. companies and leading industries. An investment may not be made directly in an index. Barclays Aggregate Bond Index is an index commonly used as a benchmark by both passive and active investors to measure portfolio performance relative to the U.S. dollar-denominated investment-grade fixed-rate taxable bond market. An investment may not be made directly in an index. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.